ExamPrep.School. Texas Life Agent Insurance Exam, exam code INSTX-Life01. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1: completing the application, underwriting, and policy delivery, policy riders, provisions, options, and exclusions, retirement and other insurance concepts, Texas statutes and rules common to life and health, Texas statutes and rules specific to life insurance, types of policies. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Which statement best describes the level premium funding mechanism of an ordinary straight whole life insurance policy? A. Premiums decrease over time as accumulated cash value offsets mortality charges. B. Premiums are level because early year payments exceed the net level cost, creating cash value to offset later year costs. C. Premiums fluctuate annually based on insurers' actual mortality and expense experience. D. Premiums are fully flexible and can be adjusted by the policy owner within defined limits. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is the option describing that early year premium payments exceed the net level cost to build cash values that offset later year mortality expenses. An ordinary straight life policy uses a level premium method, averaging mortality charges and interest over the insured's lifetime. Reason A is not correct. Premiums do not decrease over time. The level premium method keeps payments constant. Reason C is not correct. Premiums are fixed at issue, not adjusted annually to actual experience. Reason D is not correct. Policy premiums under an ordinary straight life plan are not flexible after issue. Question 2. Which of the following is a characteristic feature of a 20-pay limited pay whole life insurance policy? A. Premiums increase after 20 years to maintain coverage to age 100. B. Premiums are payable for 20 years, after which the policy is fully paid up. C. Premiums are flexible and may vary within limits set by the insurer. D. Premiums must continue until the insured reaches age 100. The correct answer is B. The correct answer is the feature stating that premium payments cease after 20 years, and the policy remains in force as paid up. A 20-pay limited pay whole life plan concentrates level premiums into a 20-year period. Reason A is not correct. Premiums do not increase after 20 years. Coverage continues without further payments. Reason C is not correct. Premiums under a limited pay plan are fixed at issue and not flexible. Reason D is not correct. Premium payments in a limited pay plan end after the specified pay period rather than continuing to age 100. Question 3. A client purchases a single premium whole life policy with a $50,000 payment. According to the policy's cash value accumulation schedule, the cash value at the end of year 1 is $48,000 and the cash surrender value is $45,000. Which factor primarily accounts for the difference between the cash value and the surrender value? A. Mortality charges deducted at surrender. B. A surrender charge deducted from cash value. C. Adjustment for guaranteed interest rate. D. Dividend accumulation applied at issue. The correct answer is B. The cash surrender value is the cash value less a surrender charge, which the insurer deducts to cover acquisition and administration costs. Reason A is not correct. Mortality charges are already reflected in the reserve and not separately deducted upon surrender. Reason C is not correct. Guaranteed interest rates affect accumulation, but do not explain the reduction between cash and surrender values. Reason D is not correct. Dividends, if applicable, increase value rather than reduce the surrender amount below cash value. Question 4. A 20-year modified premium whole life policy offers reduced premiums during the first 10 years, followed by higher premiums thereafter. Compared to a level premium whole life policy, which of the following best describes the cash value accumulation in the first 10 years of the modified premium policy? A. Greater accumulation due to reduced early premiums. B. Lesser accumulation because early premiums are lower. C. Equal accumulation since total premiums match. D. Variable accumulation depending on dividend performance. The correct answer is B. Lower initial premiums result in smaller annual net payments into the policy, producing less cash value accumulation in the early policy years than under a level premium schedule. Reason A is not correct. Greater accumulation would require higher premiums, but early premiums are intentionally lowered. Reason C is not correct. Total premiums over time differ, so early year accumulations are not equal. Reason D is not correct. Dividend performance can affect value but does not override the impact of reduced premiums on early accumulation. Question 5. For a non-variable universal life insurance policy, which of the following accurately characterizes the option B death benefit? A. Specifies an increasing death benefit comprised of the policy face amount plus cash surrender value, maintaining a corridor over cash accumulation. B. Provides a level death benefit equal to the original policy face amount, causing the net amount at risk to decline as cash value grows. C. Offers a decreasing term benefit that decreases proportionally to cash value, ensuring the total death benefit remains constant. D. Guarantees a level death benefit equal to the greater of the face amount or the cash surrender value on each policy anniversary. The correct answer is A. This option is correct because the option B death benefit increases over time and equals the sum of the policy's face amount plus its accumulated cash surrender value, maintaining the IRS mandated corridor. Reason B is not correct. Describes a level benefit with declining net risk as cash value grows, rather than an increasing benefit including cash value. Reason C is not correct. Reflects a structure where a decreasing term offset maintains level total benefit, not the rising combination of face plus cash value. Reason D is not correct. Uses a greater of formula instead of summing face amount and cash value as required under option B. Question 6. Julia holds a universal life policy that credits interest to her policy's cash value at a current declared rate subject to a guaranteed minimum. This year, the insurer declared a 5% interest rate based on its general account yield after expenses. Which mechanism best describes how Julia's credited interest is determined? A. Declared interest rate set by insurer above guaranteed minimum. B. Indexed rate tied to a stock market index performance. C. Cash value adjusted by insurer's surplus earnings. D. Guaranteed minimum rate only when declared rate falls short. The correct answer is A. The declared rate mechanism sets the interest credit by board resolution based on the insurer's yield above a guaranteed floor, which matches universal life practice. Reason B is not correct. Indexed rates apply only to indexed universal life, not traditional universal life. Reason C is not correct. Surplus earnings adjustments occur in participating policies, not in universal life crediting. Reason D is not correct. The guaranteed minimum applies only if the declared rate falls below the floor, not as the sole basis. Question 7. David reviews his flexible premium adjustable life policy statement and notices a monthly deduction of $120. Which of the following components most accurately represents how this deduction is calculated? A. Only guaranteed and secondary guarantee period expense deductions. B. Assumed interest expense deductions based only on the policy debt. C. Net premium minus credited interest without mortality cost. D. Guaranteed minimum death benefit. The correct answer is D. Monthly deductions include the policy's cost of insurance, expense loading, and rider charges, reduced by the interest credited to the cash value. Reason A is not correct. Guaranteed period deductions relate to loan interest guarantees, not regular policy charges. Reason B is not correct. Interest expense based on financial debt does not reflect mortality and expense charges in this policy. Reason C is not correct. Mortality cost must be included. Net premium minus interest omits key charges. Question 8. Under Texas regulations for term life insurance, how many days after the expiration of the level term period must the insured exercise the conversion exchange privilege? A. Immediately upon expiration of the level term period. B. Within 15 days after expiration of the level term period. C. Within 31 days after expiration of the level term period. D. Within 60 days after expiration of the level term period. The correct answer is C. The correct answer is within 31 days after expiration, because Texas law requires that the conversion privilege be exercised within that 31-day period following the last level term period. Reason A is not correct. The exchange privilege extends beyond the exact expiration date and is not confined to the moment of expiration. Reason B is not correct. The regulatory period is longer than 15 days and specifies a 31-day window. Reason D is not correct. 60 days exceeds the statutory conversion window specified in Texas regulations. Question 9. Under Texas law, renewable term life insurance policies may be renewed without evidence of insurability up to what maximum insured age? A. Age 65. B. Age 70. C. Age 75. D. Age 80. The correct answer is B. Renewable term policies in Texas can be renewed without proof of insurability until the insured attains age 70, as mandated by state regulation. Reason A is not correct. Age 65 is a common conversion threshold, but the renewal privilege extends to a later age. Reason C is not correct. Age 75 exceeds the statutory renewal limit set by Texas law. Reason D is not correct. Age 80 is beyond the maximum age allowed for renewal without evidence of insurability. Question 10. A 30-year-old client purchases a 15-year level term life insurance policy with a return of premium rider. The policy documentation lists the annual base and rider premiums in the following table. At the end of the 15-year term, what return of premium benefit will be paid? A. $7,500. B. $2,250. C. $8,250. D. $15,000. The correct answer is C. The return of premium benefit equals the sum of all premiums paid over the 15-year term, including base and rider. Each year totals $550, so $550 multiplied by 15 equals $8,250 returned. Reason A is not correct. This reflects only the sum of base premiums, excluding the rider portion. Reason B is not correct. This sums only the rider premiums, not including the base premium amounts. Reason D is not correct. This doubles the combined base and rider premiums instead of summing them correctly. Question 11. A homeowner obtains a $360,000 30-year mortgage and simultaneously purchases a 30-year decreasing term life policy. The policy's face amount decreases by $12,000 each year, in parallel with the mortgage balance. If the homeowner dies exactly after 7.5 years, what death benefit will the policy pay? A. $360,000. B. $276,000. C. $270,000. D. $252,000. The correct answer is C. The death benefit declines by $12,000 per year. After 7.5 years, the reduction is $12,000 multiplied by 7.5 equals $90,000. So $360,000 minus $90,000 equals $270,000 paid. Reason A is not correct. This is the original amount and does not account for any decreases over time. Reason B is not correct. This implies an incorrect multiplication of years by the annual decrease. Reason D is not correct. This reflects a larger year reduction than the 7.5 year specified. Question 12. If a client purchases a single premium immediate annuity on June 15, 2023, by which date must the first income payment be made to satisfy the income start date rule for immediate annuities? A. July 15, 2024. B. June 15, 2024. C. June 15, 2025. D. January 15, 2024. The correct answer is B. The correct answer is that annuity payments must begin within 1 year of the purchase date. So the first payment must occur by June 15, 2024. Reason A is not correct. This date is over 1 year and 1 month after purchase, exceeding the maximum deferral allowed for an immediate annuity. Reason C is not correct. This date is 2 years after purchase, far beyond the 1 year requirement for income to start. Reason D is not correct. This date is only 7 months after purchase, which is earlier than the required maximum deferral period. Question 13. A 65-year-old client purchases a fixed deferred annuity with a guaranteed minimum interest rate of 3%. In the second contract year, the insured declares a current interest rate of 2.5%. How much interest will be credited to the annuity contract for that year? A. 2.5%. B. 2%. C. 3.5%. D. 3%. The correct answer is D. The guaranteed minimum rate applies when the declared rate falls below it. Since 2.5% is below the 3% guarantee, the contract is credited at 3%. Reason A is not correct. This reflects the declared rate rather than the guaranteed minimum. The contract credits the higher guaranteed rate. Reason B is not correct. This is below the declared rate and guaranteed minimum, so it cannot be credited. Reason C is not correct. This exceeds both the declared rate and the guaranteed minimum without basis in the contract terms. Question 14. A married couple ages 68 and 65 purchases a joint and survivor immediate annuity with a 75% survivor benefit and a payout reduction factor of 0.88. If a comparable single life annuity at the husband's age would pay $1,200 per month, what monthly benefit will the couple receive? A. $1,056. B. $900. C. $1,200. D. $1,440. The correct answer is A. The joint and survivor benefit is calculated by multiplying the single life payout by the reduction factor. $1,200 multiplied by 0.88 equals $1,056 per month. Reason B is not correct. This reflects an incorrect reduction factor or miscalculation of the joint and survivor benefit. Reason C is not correct. This is the single life amount and does not account for the reduction factor. Reason D is not correct. This applies an incorrect increase rather than the required reduction factor. Question 15. A married couple with a combined estate valued at $25 million establishes an irrevocable life insurance trust, ILIT, and funds it with a second-to-die survivorship policy. They pay premiums from separate accounts, and upon the death of the surviving spouse, the trust receives the death benefit to cover federal estate taxes. Which statement best describes how this arrangement achieves their estate planning goal? A. Premium payments made to the trust owning the policy qualify for the annual gift tax exclusion, without using lifetime exemption. B. The accelerated death benefit rider attached to the survivorship policy allows the couple to access its cash value during lifetimes. C. The irrevocable life insurance trust owns the survivorship policy, keeping the death benefit out of both spouses' taxable estates. D. A first-to-die benefit provision in the policy reduces estate tax liability immediately upon the first spouse's death. The correct answer is C. The irrevocable trust holds ownership of the survivorship policy, so the death benefit is excluded from both spouses' estates and avoids federal estate tax. Reason A is not correct. While gifts to the trust may qualify for the annual exclusion with proper notices, that alone does not exclude the death benefit from the estates without trust ownership. Reason B is not correct. Providing access to cash value does not address removing the death benefit from the taxable estates, so it fails the estate tax objective. Reason D is not correct. A first-to-die provision pays out on the first death, not the surviving spouse's death, so it cannot fund estate taxes due after both have died. Question 16. Under a typical waiver of premium rider, what is the standard elimination period before the insurer begins waiving premium payments due to total disability? A. 30 days. B. 60 days. C. 180 days. D. 365 days. The correct answer is C. The correct answer is 180 days, as most waiver of premium riders specify a 6-month elimination period before waiving premiums for total disability. Reason A is not correct. A 30-day period is too short. Waiver of premium provisions typically use a longer elimination period. Reason B is not correct. A 60-day period is shorter than the common 6-month requirement in standard waiver of premium riders. Reason D is not correct. A 365-day period is excessively long and exceeds the usual 6-month waiting period. Question 17. Which set of ages typically corresponds to the exercise dates allowed under a guaranteed insurability option for additional life insurance coverage? A. 25 år, 31, 34, 37 for den. B. Under 25, 30, 40 for something. C. 30 things, 45, 56, D. 18, 22, 26, 30, 35, 31. The correct answer is A. The correct answer is 25, 28, 31, 34, 37, and 40, which reflect the standard interval ages at which the guaranteed insurability option may be exercised. Reason B is not correct. Those ages do not align with the standard interval schedule specified in typical guaranteed insurability options. Reason C is not correct. Those ages start too late and exceed the usual age limits for exercising a guaranteed insurability option. Reason D is not correct. Those ages occur at irregular intervals and do not match the conventional exercise dates. Question 18. A term life policy includes an accidental death benefit with a double indemnity clause. 6 months after a minor car accident, the insured suffers a fatal heart attack unrelated to the accident. The beneficiary submits a claim for benefits. Under the terms of the double indemnity clause, what amount will the insurer pay? A. Payment of the base policy, face amount only. B. No benefits because the cause of death was unrelated to the accident. C. Payment of twice the face amount under the double indemnity provision. D. Payment of the base face amount plus an additional accidental death benefit equal to the face amount. The correct answer is A. The double indemnity clause applies only when death results from an accidental cause as defined in the policy. Since the heart attack was unrelated, only the standard death benefit is payable. Reason B is not correct. This choice is incorrect because the policy still pays the base death benefit, even if the accidental death benefit does not apply. Reason C is not correct. This choice is incorrect because doubling the face amount only occurs when death is accidental per policy definition. Reason D is not correct. This choice is incorrect because no additional accidental benefit is payable when the death cause is unrelated to the accident. Question 19. An insured holds a whole life policy with a cost of living adjustment rider linked to the CPI. The policy's face amount is $250,000 and last year's CPI rose by 2.5%. If the insured elects the adjustment, what change will occur under the rider? A. Death benefit rises by 2.5% to $256,250 and premium increases in proportion. B. Death benefit rises by 2.0% due to CPI rounding and premium stays the same. C. Death benefit and premium increases occur only when CPI change exceeds 3%. D. Death benefit stays at $250,000 since CPI change is below the minimum indexed threshold. The correct answer is A. ACPI linked. COLA rider increases the death benefit by the full percentage change in CPI regardless of thresholds, and premiums adjust proportionately to fund the higher benefit. Reason B is not correct. This choice is incorrect because the rider uses the actual CPI percentage and premiums adjust accordingly. Reason C is not correct. This choice is incorrect because there is no threshold requirement. All CPI changes trigger adjustments. Reason D is not correct. This choice is incorrect because the rider does not impose a minimum index change before applying increases. Question 20. A participating whole life policy credits interest on an annual basis. If the policy is surrendered 8 months after the last policy anniversary, how is the interpolated cash surrender value calculated before deducting any surrender charges? A. Reserve at last anniversary plus reserve at next anniversary divided by 2. B. Reserve at last anniversary plus reserve at last anniversary multiplied by 8 divided by 12. C. Reserve at next anniversary. Reserve at next anniversary multiplied by 4 divided by 12. D. Reserve at last anniversary plus reserve at next anniversary, reserve at last anniversary multiplied by 8 divided by 12. The correct answer is D. The correct answer uses linear interpolation between the reserves at anniversaries. Start with the reserve at last anniversary, add the proportional increase for 8 months, then subtract any surrender charges. Reason A is not correct. A simple average of the two reserves ignores the actual time elapsed since the last anniversary. Reason B is not correct. This method adds simple pro rata interest to the earlier reserve rather than interpolating between two anniversary reserves. Reason C is not correct. This option subtracts a prorated reserve from the later anniversary instead of adding the appropriate increment to the earlier reserve. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.